Hi everyone, welcome back to Corporate Decoder, the place where we dig through mountains of corporate paperwork so you don't have to. Today, we're diving into a shareholder report, so get ready to know more about what happens behind those company walls. I can already tell this is going to be a wild ride. Before we start though, if you appreciate simple insights from complicated corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where you can share the interesting details that you notice in documents yourself. We are breaking down an annual shareholder report for the Toews Agility Shares Dynamic Tactical Income ETF and the Toews Agility Shares Managed Risk ETF, both for the year ending in April 2025. This report tells investors how the funds performed, what they invested in, and the costs involved. It's basically a financial health checkup for the funds. First, let's talk about costs. For the Toews Agility Shares Dynamic Tactical Income ETF, the costs of a $10,000 investment were $97, or 0.95%. It means of every $1,000 you invested, $97 went to cover the fund's expenses. Now, how did the Dynamic Tactical Income Fund perform? Its return was 4.04%. However, the Bloomberg US Aggregate Bond Index, which is often used as a point of comparison, rose by 8.02% during the same period, so the fund didn't do as well as the benchmark. The report says that the Dynamic Tactical Income Fund doesn't try to follow a specific roadmap and tends to underperform in very strong markets, and instead tries to make money by dodging major downturns. Here's a look at the total return based on a hypothetical $1,000 investment since the fund started. Back in June of 2020, $1,000 invested in the Toews Agility Shares Dynamic Tactical Income ETF would be worth about $10,722 in April 2025. Over the same time period, an investment in the ICE-BOFA High Yield US Corporates Cash Pay Index would be worth about $12,8044. The Bloomberg US Aggregate Bond Index would be worth only about 9,570 ICE-BOFA High Yield US Corporates. Cash Pay Index would be worth about $1,207.22 in April 22 had afford money and not kept up with inflation. Some other things about this Dynamic Tactical Income ETF. Its net assets were about $36.6 million. That's the total value of everything it owns minus what it owes. The fund held only 4 investments in its portfolio. Its advisory fee was about $12.82 that Shent. Our OLSIPs, it's what they paid the people managing the money. It has a high portfolio turnover of 679%. They swapped out their investments multiple times, meaning a lot of buying and selling went on. Let's turn our attention towards the Toews Agility Shares Managed Risk ETF. For the Toews Agility Shares Managed Risk ETF, the cost of a $10,000 investment was only $99, or 0.95%, almost the same as the other fund. The Managed Risk ETF returned 798%, which is less than the S&P 500 index's 12.10% gain, once again underperforming. This fund follows a very structured strategy to protect against losses while still participating in the stock market growth. So when the stock market rises, this fund will tend to do worse than the market rise. It's kind of like an insurance policy. Here's a look at the total return based on a hypothetical $1,000 investment since the fund started in June 2020. $1,000 invested in the Toews Agility Shares Managed Risk ETF would be worth about $15,926,500. Buy right index would be worth about $15,925. And an investment in the CB100 buy right index would be worth about $15,925. Buy right index would be worth about $15,645. An April 26,500 buy right index would be worth about $15,095. And investment $45 in 25 owners Singapore 500 buy right index would be worth about $15,500. Buy right index would be worth about $15,095, and an investment 500 buy right index would be worth about $1,645, and April 25 right index would be worth about $15,900, would be worth a stunning 1965. Some other things about this Managed Risk ETF. Its net assets were about $265.4 million, a lot more than the other fund. This fund held only 3 investments. Its advisory fee was about $1.4 million. Again, it's what they paid the people managing the money. It has a portfolio turnover of 6%. Basically, they held mostly the same things. Moving on now to the audit side of things. For 2025, the audit fees were about $3,200 for both funds. These are the fees paid to the people checking the fund's books. Tax fees were $7,800 for tax preparation for both funds. The report also says that Mark Gersten, Anthony Hertel, and Mark H. Taylor are considered the financial experts for the audit committee. You can find a detailed list of the fund's holdings in the financial part of the report. That means all the company names, what they do, etc. Go check it out if that is interesting to you. These funds are part of a bigger thing called the Northern Lights Fund Trust. They are set up as fund of funds, which means they mainly invest in other investment companies. The Dynamic Tactical Income Fund wants to give you income, while the Managed Risk Fund aims for both income and growth with less risk. The funds value their investments by different methods depending on what they are. Stocks are valued at their last sale price. Securities that don't have prices easily available are valued using fair value procedures to estimate what they're really worth. When the funds use options contracts, they take on some risk. If the option expires, there's a gain or a loss. If a call option is used, it affects how they sell any related assets. As writer or purchaser of an option, the funds have no control over whether the option will be exercised. The report says that these funds typically pay out their income from investments each month or year. Any profits they make from selling investments, called capital gains, they usually give to shareholders once a year. The funds plan to follow the rules for investment companies and give all their taxable income to their shareholders, so they don't have to pay income tax themselves. Toews Corporation is in charge of managing the funds. The funds pay Toews a fee based on how big the funds are. The report says Toews also agreed to keep costs down, ensuring that total yearly expenses don't cross some limits. Any fees that Toews doesn't charge can be taken back in the next 3 years if the fund makes enough money. So the funds and managers has created an agreement to make it so the investments make returns for everyone and that it's still a profitable operation. There are a lot of risks that come with investment management that come up, like fluctuating net asset value or market risks. Some other risks are from different things related to investing, like economic growth and interest rates. Also, there are things like cybersecurity risk and newly formed company risk. The report also includes details about how much money the funds would make or lose if they sold their investments based on tax rules. Some of the money that you get as a shareholder can be taxes as different ways. Dividends can be considered income. When the fund sells investments for more than the cost to buy them, that can be considered capital gains. Both of these things come into play when tax season comes around, so it's good to be aware. To earn more money, the funds can loan their investments to other companies, but there's a risk involved. Maybe the company that borrowed it fails to return it. This is very carefully monitored and is usually a pretty safe practice. Since the funds put money into other ETFs, they face other risks based on what kind of ETFs they are. These risks can be related to how easy it is to buy or sell them or the industry that they operate in. The report also says that nothing major has happened after the period covered that would change the numbers. Now, looking at these results more broadly, both funds, while having some gains, underperformed standard benchmarks. I'm mostly fine with that given both funds tried to avoid volatility. However, there is a question of whether those management fees were justified if both funds underperformed standard approaches that any investor can get into. The Dynamic Tactical Income ETF had a crazy high turnover rate, and that should be investigated as it leads to lower returns and potentially some self-dealing on the part of the investment company. The Toews Corporation did do one thing really well. It controlled costs while managing the fund. Expenses are mostly reasonable for a fund of this type. This gives Toews some credit in my book as there's much less egregious conduct going on. Overall, I'd consider this a solid if underperforming investment. Alright, that's our breakdown of the Toews Agility Shares Fund's annual shareholder report for April 2025. What's your take on these numbers and what they signal about these companies' future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.